morning, everybody, and welcome to this month's webinar. In this month, we're looking at a very topical issue, and that is determining the incremental borrowing rate when you implement and continue to apply the new AASB or IFRS 16 on leases. So welcome to this morning's webinar. Today, we have 4 presenters. As always, I've got Kevin, our IFRS advisory partner based in Sydney, with me. Morning, Kevin.
Good morning, Aletta, and good morning, everybody.
And then we also have 2 guest presenters. We've got Martin Emelson from Corporate Finance in Melbourne. Morning, Martin.
Morning, Aletta. Thanks for having me.
You're welcome. And then also we have David McCourt, who's a corporate finance partner in Sydney. Morning, David.
Good morning, everybody.
So the reason we have David and Martin here is that Kevin and I are, as you know, real IFRS nerds, or Kevin will say you're speaking for yourself, Aletta. And luckily I've muted him before I made the comment. So we've got David and Martin here to give us more a practical context, what they see in practice, what they do for clients in practice, and how they can help us going forward on coming up with this incremental borrowing rate. So a bit of an overview of our webinar. I will start with providing a bit of background on how incremental borrowing rate links to the standard. The corporate finance partners, or one of them, I won't name names, David, did count how many times incremental borrowing rate is referred to in the standard, and apparently it's only 6 times, and then it's up to corporate finance partners to do the hard work after that. So I'll provide a bit of background, and then I'll also do a bit of a discussion around the timing of the determination of the appropriate discount rate. I'll then hand over to Kevin, who will look at the unit of account, and he will look at the IFRS guidance rules requirements around developing an estimate of the incremental borrowing rate. And then finally, in our last section, we look at a number of practical issues, and that is where David and Martin will contribute with their experiences and what they do. So here we go. Background. As you know, under AASB 16 or IFRS 16, when we first implement the new standard, but also on an ongoing introduction of new leases, the whole calculation starts with the initial measurement of the lease liability. And once you've determined the lease liability, on the left-hand side, that is an input to a determination of the right of use asset. So every calculation on day one starts with the lease liability and then goes to the right of use asset. And we know in future, as we have reassessments or modifications, it's a similar approach. You adjust your lease liability, and that will have a flow-on effect to the right of use asset. So if you look at your lease liability, we start with the fixed payments from the commencement date. We add certain variable payments, those that are in substance fixed. We consider residual value guarantees. We include the exercise price of purchase options. We consider termination penalties, and all of these payments are discounted using an incremental borrowing rate. And yes, that then flows through to your right of use asset. You know, the lease liability is a starting point. You add direct costs, cost of removal, payments prior to commencement, lease incentives, etc. So if we then look at an appropriate discount rate, which is really critical to determining the lease liability, one could say, on the one hand, you have to come up with the cash flows, as we've illustrated on the previous slide, and on the other hand, what is the appropriate discount rate to discount those cash flows to day one. I think it's important to say that the objective of the International Accounting Standards Board is to specify a discount rate that reflects how the contract is priced. So that is a conceptual approach. That's what they want to achieve, and that comes out of the basis for conclusions. So a discount rate that reflects how this particular contract is priced. In IFRS 16, in paragraph 26, it specifically says that at the commencement date, by the way, what is the commencement date? The commencement date is the date that the asset is made available for use. It's not the date we sign the agreement. It's not the date we enter into the agreement. So at the commencement date, a lessee shall measure that lease liability at the present value of the lease payments that are not paid at that date. So present value of future lease payments. The lease payments shall be discounted using the interest rate implicit in the lease, if that rate can be readily determined. And if that rate cannot be readily determined, the lessee shall use the lessee's incremental borrowing rate. And as you know by now, I think in pictures, or I think in diagrams, and therefore I looked at that paragraph and thought, okay, what it says is, can the interest rate implicit in the lease be readily determined? And if we say yes, we can determine it, readily determined, then we use that interest rate implicit in the lease. If it cannot be readily determined, we use the lessee's incremental borrowing rate. And this is really important. You cannot look at a new lease and just ignore the interest rate implicit in the lease and go for an incremental borrowing rate. There's a little bit of a decision first, an assessment first. If we then focus on the interest rate implicit in the lease, which is the starting point, because if it is readily determined, this is what we should go with. What is the interest rate implicit in the lease? Now, it's the rate of interest that causes the present value of lease payments and the unguaranteed residual value to equal the sum of the fair value of this underlying asset and the initial direct costs of the lessor. So on the one hand, we have the present value of lease payments and unguaranteed residual values, and we compare that to the equal it has to equal the sum of the fair value of the underlying asset and initial direct costs. So it's kind of two different things, and we're looking at a rate that causes the present value of the one side to equal the sum of the fair value, etc., on the other side. That would be the rate implicit in the lease. Now, if you look at that, I've highlighted two aspects. The one is that unguaranteed residual value I've put in yellow. And the other thing is I've included there the initial direct costs of the lessor I've put in blue. And that was not a slip. That was intentional. And the reason is those are the two aspects that often the lessee cannot assess easily, don't have access to the information, could make it difficult to do this assessment. And remember, the test is it readily determinable? So if we cannot readily determine our unguaranteed residual value, or we cannot readily determine initial direct costs of the lessor, not our initial direct costs, but the initial direct costs of the lessor, then one could say, hang on, it's not readily determinable. So that's really why I've focused your attention to that. Now, unguaranteed residual value, why do I say it's difficult for the lessee to assess that? Because unguaranteed residual value is that portion of the residual value of the underlying asset where the realization of that, sorry, I just want to check something. Sorry. Just making sure the sound is working. I apologize. the unguaranteed residual value is that portion of the residual value of the underlying asset where the realization by the lessor is not assured, or it is guaranteed solely by a party related to the lessor. Therefore, you can see for the lessee to assess that or to know about that, really difficult. And then if you look at a lessor, obviously, how do we know what the initial direct costs of the lessor are? So if I go back to my previous slide, I would say, can the interest rate implicit in the lease be readily determined? Yes or no. It really depends on whether we know what the unguaranteed residual value would be, whether we have access to it, and also do we know what the initial direct costs of the lessor are. Now, to be fair, in practice, I would say 99.9% of my clients would say it's not readily determined, and therefore I've seen that our clients use incremental borrowing rate, and determining incremental borrowing rate, therefore really a hot topic, hence our webinar. So in this slide, I've just put a number of arguments together to say, listen, just think carefully whether you can readily determine that implicit interest rate. So if you use that implicit interest rate, the true cost of financing of leasing an asset as opposed to paying for it upfront or buying it outright without financing, if we allow incremental borrowing rate to be used, we acknowledge that a lessee is often not be able to determine it. And I've put a number of examples on why and explained really on the slide what I've just explained to you in conversation. So I'll move on from this. So if we then say, hang on, we could not readily determine the implicit interest rate, we now go on to incremental borrowing rate of the lessee. What would that be? Now, the rate, the incremental borrowing rate of the lessee is the rate of interest that a lessee would have to pay to borrow over a similar term and with a similar security. So you can see here, we're looking for similar term. Therefore, we cannot have leases that have a 5-year term necessarily have the same incremental borrowing rate as a lease with a 20-year term. So what is the rate of interest that we would have to pay to borrow over similar term, similar security? Therefore, again, there's a difference between property leases, vehicle leases, equipment leases, different types of security potentially. And it's the funds necessary to obtain an asset. So what would I have to pay to borrow to obtain an asset instead of leasing an asset? Again, the asset has a similar value to this right of use asset and in a similar economic environment. So there's a lot of similars in here. Similar term, similar security, similar value, similar economic environment. So in this diagram, we try and put that all together again, just in a picture. And we're saying, when we come up with a lessee's incremental borrowing rate, we usually start with a base rate where we look at a base rate for economic factors. So we look at a similar economic environment, term, and value. And then we make adjustments for financing factors, so lessee specific factors. Remember, incremental borrowing rate, it's the lessee's incremental borrowing rate. It's not an incremental borrowing rate in the market as a whole, right? It's the lessee's incremental borrowing rate. So lessee specific factors, what the lessee would have to pay, not what others will have to pay, what this lessee will have to pay. And then we also overlay asset factors, and that's where the similar security comes into play. So all of these things build up to coming up with an incremental borrowing rate for the lessee. So if we continue that discussion a bit further, the incremental borrowing rate is not the interest rate that an entity pays on other debts. However, often when we meet with clients, that is a handy starting point. We would say, do you currently have debt? Do you have bank loans? Do you have revolving credit facilities, etc.? If the client says yes, we'd say, okay, what rate do you pay on those? We're not saying that's your incremental borrowing rate. We're just saying that's a good starting point or a benchmark. So these rates would be put into measuring your IBR, or it may be appropriate solely on the basis of materiality. So the problem with using this rate and why it's not always appropriate is often the rate that you're currently paying on your bank loan is not for a similar term, might not have similar security, and it might not have other economic characteristics similar to your underlying lease. So, you know, the IBR is not the interest rate you currently pay on other debt. However, handy starting point, handy consideration. Not the only thing. A discount rate is not determined for an entity as a whole, but it has to be determined for each individual lease. And it's because each individual lease would have different terms, different securities, etc., as discussed on the previous slide. We acknowledge that estimating the incremental borrowing rate may be difficult, and therefore we often have to come up with an estimate, and we have to put in several inputs to arrive at an appropriate incremental borrowing rate. And I think it's important to say here, and it's just a little bit of a reminder for me, when we earlier talked about is it readily determinable to come up with an implicit interest rate, some people have argued, listen, it is readily determinable because we can make some estimates of what we think it's costing the borrower, what we think the the lessor's initial cost are, what we think the unguaranteed residual values are. We could estimate all of those. As soon as you start to estimate to come up with an implicit interest rate, it's no longer readily determinable. If you want to start to estimate and use all these inputs, then you're squarely in the category of incremental borrowing rate and estimating the lessee's incremental borrowing rate. So please don't confuse the two. The other thing that's important, an entity's weighted average cost of capital is not appropriate to use as a proxy for the IBR. Because it's not representative of the rate an entity would pay on borrowings. This is like as a general rule, a general starting point. But as always, there might be situations where it could be appropriate if all the facts and circumstances line up, and we'll discuss some of that a bit later. The reason why it's generally not appropriate is because the weighted average cost of capital incorporates the cost of equity-based capital, which is unsecured and ranks behind other creditors, and therefore will be a higher rate that you pay on borrowings, and we're looking for something that the lessee would pay. And therefore, you know, be careful if you want to use the WACC, and actually generally not accepted to use that. So that's a little bit of an introduction, a little bit of a background to why we're talking about determining incremental borrowing rate today. The next section is talking about timing of the determination of the discount rate. Now, first of all, I've come up with a number of broad categories. I think I've got 3 broad categories. In the first one, you would have to determine incremental borrowing rate when you have new leases. So every time you enter into a new lease, for initial recognition, you have to determine incremental borrowing rate. And why I'm making a bit of a song and dance of this is some clients have thought, you know, they come up with incremental borrowing rate when they implement the standard and then they just forget about it. This is actually a continuous process. If you are entering into new leases every 6 months or every month or every 3 months, you know, you will have to continuously determine an incremental borrowing rate. And therefore, it would be worth your while to have some kind of model to assist you or approach, which the corporate finance guys can help you with, that you could update the information on a regular basis. It's not a once-off calculation and then you forget about it. So whenever you have new leases and as regularly as you have new leases, you will have to come up with an incremental borrowing rate. Then the interesting thing is that there is a little bit, sometimes there can be a bit of a delay between contract inception, the day you sign the agreement, and the commencement date of the lease. And as I've discussed earlier, commencement of the lease is the date the asset is actually made available for use. So sometimes we can negotiate a new lease of a plane or a building 18 months, 2 years in advance of actually starting to use it. Therefore, are we going to use incremental borrowing rate at contract inception or when we start to use the building or the aircraft, commencement of the lease? So it's important to note that the discount rate that we should use is at the commencement date of the lease. And it's because the standard in paragraph 23 requires a lessee to measure the right of use asset at the commencement date. The applicable discount rate is a component of the measurement of the lease. It's a component of coming up with the lease liability on day one. And therefore, we have to come up with that discount rate on the commencement date. So that's just an important thing to consider. So first category, for all new leases, you have to determine your incremental borrowing rate at commencement date of each and every new lease. However, and people often forget this, we are required to make ongoing changes to our lease portfolio. And this is a diagram that I've explained in previous webinars. And again, last month, Kevin and I just focused on this particular decision tree or overview diagram. In this diagram, I've added red blocks, and you can see I've got 4 red blocks. And these red blocks represent situations where on an ongoing basis, the standard would require you to determine a new discount rate, a new incremental borrowing rate at a particular point in time. So in these situations, when you have reassessments or modifications of leases in future, in 4 particular situations, you will have to update your incremental borrowing rate. And you can see in 2 situations, you can continue to use your original discount rate. The one is where there's a change in the lease term, you have to use a new discount rate. If you have a modification to a lease, all 3 scenarios, as soon as you modify an existing lease, you have to reassess and determine a new discount rate. So that one is fairly easy. But I think some clients have asked me, Aletta, so how often do we update incremental borrowing rates? So if you enter into a new lease, and you don't modify that lease in future, and you don't have any reassessment to that lease in future, you never have to update incremental borrowing rate. So there's no requirement to update incremental borrowing rate every reporting date for every lease. You will have a new incremental borrowing rate, obviously for new leases, but you'll also have a new incremental borrowing rate if you reassess your options that lead to a change in the lease term, or if you have modifications to your lease agreements, right? But it's just to be aware of that. And then obviously the third big category I've got is if you transition to IFRS 16. When you transition to IFRS 16, as we've discussed previously, there are 3 different transitional methods. There's full retrospective method, and there's modified retrospective method 1 and modified retrospective method number 2. So how do these methods link with incremental borrowing rate? First of all, for full retrospective method, you've got the heartache of going back and determining incremental borrowing rate at the start of all your leases. what a big task. And as I've previously said, of all my clients, only 2 clients went back and used full retrospective method and went back to assess incremental borrowing rate, etc. Very difficult to do. When you use the modified retrospective methods, whether it's 1 or 2, you use the incremental borrowing rate at the date of initial application of IFRS 16. So if you've got a 30 June 2020 year end, you would have used incremental borrowing rate on 1 July 2019. So again, important to consider all of those. In this, on this slide, I wanted to explain maybe a practical situation. If you've previously had operating leases that were accounted under AASB 117 or IAS 17, and on transition, you use this modified retrospective approach. The lease liability is initially measured at an amount equal to the remaining lease payments in future. And you discount it using an incremental borrowing rate at the date of transition. So if you've got calendar year ends 31 December, you would come up with future payments after 1 January 2019, and you look at future, you look at an incremental borrowing rate on 1 January 2019. So it's important, therefore, when you come up with your incremental borrowing rate on the date of transitioning, you'll have to look at remaining lease payments, and therefore also that will feed into the term that would impact your incremental borrowing rate. So the example that I've got here, let's say you entered into a lease on 1 January 2014 and it was a 10-year lease. The lease would cease on 31 December 2023. At the date of transition, let's say your date of transition was 1 January 2019 because you have a 31 December year end. At that stage, 1 January 2019, the lease term is only the remaining period, which is 5 years. And therefore, if you look at an incremental borrowing rate, you will look at an incremental borrowing rate with a term of 5 years and not 10 years, because you look at the remaining term of the lease. So I think it's really important to have a look at that. The next slide, I want to look at the fact that for the modified retrospective approach number 1 and 2, there is a practical expedient available on a lease-by-lease basis, which relates to incremental borrowing rate. And it says that a lessee may apply a single discount rate to a portfolio of leases with reasonably, emphasis reasonably, similar characteristics. And that would mean similar remaining lease term, similar class of underlying assets, similar economic environment. So this practical expedient is similar. This practical expedient on the date of transition is similar to an ongoing practical expedient that's available at all times, which permits the application of IFRS 16's requirements on a portfolio basis. However, this expedient that's available on transition does not establish a requirement to demonstrate that its application would not result in a materially different measurement. So when transitioning to IFRS 16, there is this opportunity to use this practical expedient. And it's fairly easy to use the practical expedient because you only have to say, listen, I'm using this single discount rate for the portfolio because it's reasonably similar. However, if you start to use practical expedients for IFRS 16 on an ongoing basis after the date of transition, there's a higher hurdle to jump because you now have to start to prove that, if I put the portfolio together, it's not materially different to keeping it all separate. And that's harder to do, more work required, and a higher threshold. Kevin, I'm absolutely exhausted, and therefore I think it's time to throw it over to you so you can talk about unit of account. Thanks, Kevin.
Thank you, Aletta, and thank you for that. It's a very good introduction, and as I'm sure our attendees are hearing, it is a complicated standard or concept to put together. Now, I'm going to look at unit of account, and Aletta's already touched on it. And essentially, with the unit of account, if we go to the first slide on unit of account, Aletta's touched on the concept that this standard is applied, or IFRS 16 is applied to individual leases. And I think that point has been made clear both today and in all the previous webinars and literature that we've provided. The lessee or the lease standard is applied on individual lease basis, which is why this standard is proving so complicated for a lot of organizations, because if you can imagine, if you have, let's say, 30 property leases, really the standard needs to be applied for 30 leases on an ongoing basis. And all property leases, let's say, have ongoing measurements and reassessments, which means on a monthly basis, really, every one of those leases requires the various inputs to be either remeasured or reassessed, and that is true for the discount rate as well. Now, Aletta's already touched on the individual leases and the discount rate, let's say at the start of the lease, so new leases, as well as if there's a change in the lease term or if there's actually changes to the underlying contract. What I'm going to talk about here, just on a brief basis, is the portfolio approach. Now, on transition, Aletta's also touched on that. There is a practical expedient for portfolios of leases to apply a practical expedient, let's say, on the discount rate, but that practical expedient extends also to the ongoing application of the standard. So paragraph B1 is your friend in this case, and that's the concept that as a practical expedient, the standard can be applied on a portfolio of leases. And the criteria they give here is that the leases must have similar characteristics where the effects of applying the standard to the portfolio would not differ materially from applying IFRS 16 to the individual leases. Now that's a lot of words and a big mouthful. And of course, there's not much more guidance in the standard than that. So of course, there's a lot of different approaches emerging out there, but this does exist where the unit of account essentially moves from an individual lease to a portfolio approach, and that would then also extend to, let's say, the application of the discount. Now, before we move on, I just want to point out the last point there on the slide, which is before an entity determines the IBR for a contract or a portfolio, the entity must first satisfy themselves that the portfolio has been established basically to comply with the paragraph B1 above. And that's important. Don't move on to the portfolio application when you get to the discount rate if you haven't actually established that there was a portfolio to begin in the application of the standard as a whole. So remember, this standard or this unit of account portfolio exemption applies to portfolios of leases where the standard is applying to the portfolio as opposed to the individual lease. So it's not that you determine to apply the discount rate to individual leases on a portfolio basis. You must apply the standard to the portfolio, and the portfolio must have been established first as having the similar characteristics and the materiality requirement in the second bullet point. So let's move on to a couple of examples. I think the best way to do this is to apply what we mean in an example. Now, I must point out at this point, this is the disclaimer part of the presentation. These examples are developed almost on a semi-practical basis, and the corporate finance partners who are coming next, they will start to get into the nitty-gritty of some of these concepts. But these are sort of semi-practical examples to show you what we mean. And every single one of these examples is a general example. It's a very high-level example. And there are proponents and opponents to these examples actually being practical applications of the standard. So they're demonstration examples at their best. But it does demonstrate the concepts of what we're thinking about here. So what I'm going to do is actually go through each of these 4 examples on a sort of a training or semi-practical basis and leave the comments to our corporate finance partners if they actually want to drill down into some of these issues. But let's just take a look at them first. So yeah, we have an example where we've decided to apply the portfolio approach to our real estate leases, and 2 portfolios have been identified. And the portfolios in this example consist of real estate leases with lease terms of 3 to 5 years and portfolios of real estate leases with lease terms of 7 to 10 years. Now, remembering the comments that Aletta made previously, the incremental cost of borrowing is constructed of a number of concepts: a base rate with economic factors such as the economic environment, the term, and so forth, the value of the lease, financing factors, which are entity-specific financing factors, and then asset factors, which, let's say, would have similar security as one of the concepts underlying that. The reason why I've put this example up is we have run into this example in the public sector a lot. The public sector leases, some of the large public agencies and government agencies actually are developing a portfolio approach to their property leases, their real estate leases, and they're doing it on the basis of lease term, which is, let's say, 3 to 5 years and 7 to 10 years. So this is not an unpractical example. It does exist. And the reason why they're doing that is because on the surface, the portfolios that have been constructed here are generally consistent with the construct being a similar underlying asset, similar economic environment. The entity-specific factors are the same, being government agencies, because the borrowing and the credit ratings of those entities are essentially driven by the public sector credit rating for the agency or for the relevant state or federal public sector body. And the asset factors there being the actual real estate being asset-specific factors such as security. However, what we must point out is that the public sector, as a good example, they have very specific types of leases, and they're often office-based leases, and they're often actually entered into with the same counterparty. And I'll use New South Wales as an example. Many of the New South Wales property leases that are entered into by the agencies are actually entered into with Property New South Wales as an example. It's an intermediary lease, being the Property New South Wales agency that will actually enter into these leases. So in their case, it's not just that on the surface they're using an incremental cost of borrowing for real estate leases for 3 to 5 and 7 to 10 years, but actually in that case, there are master lease agreements in place. There are similar start and end dates to many of these leases, and also they're in the same territory, being in New South Wales, in the Property New South Wales example. So you probably do need to drill down to this one a little bit more, but on the surface, this does look like you could apply a portfolio approach to your real estate. Now, I have some personal questions about the lease terms, being 3 to 5 and 7 to 10. They're pretty broad terms there, and I think there are reasons why you could get to those groupings. But it is true that because of, let's say, a similar economic environment and a similar type of entity, where it's really, and a similar type of asset being real estate leases, it is possible you could construct portfolios where the lease term is perhaps a grouping, and you create an incremental cost of borrowings around that. Bearing in mind, you have to meet the requirements of B1, which is you must make adjustments to the portfolio where you apply assumptions and estimates that reflect the size and composition of the portfolio. And of course, the application must not differ materially from applying IFRS 16 to the individual leases. Hopping on from that one, we'll go to example 2, and I'll move through this relatively more quickly just to show where we're heading here. Here we have a scenario where an entity has constructed a portfolio consisting of long-term real estates, equipment, automobile, and land leases, and the lease terms range from 2 to 25 years, with lease payments totaling many times materiality. I mean, I think quickly this is the complete opposite to the example 1. It's obviously inappropriate to construct a portfolio of this nature. First of all, the lease term is just too broad. 2 to 25 is clearly too broad, and obviously it must be said, and I see it's not on the slide, but it must be said that the assets are clearly not of similar characteristics, and clearly, the asset-specific factors would certainly not allow the portfolio approach application. Yeah, so I think that's probably a good example of what not to do. If we move to example 3, and these are something that perhaps David and Martin can talk better to when they get there. And this is the group scenario where you've got a global conglomerate, or really just an entity with subsidiaries in other economic environments, where they've constructed 3 portfolios, and the leases are entered into by their subsidiaries in the relevant environment, in the relevant country, let's say, segmented by asset and lease term. Now, what's interesting here is it's essentially the same as example 1, the one where we had a real estate examples, perhaps, where the lease term was maybe 3 to 5 and 7 to 10 years. But what's different in this case is that the subsidiaries in different countries, let's say, are entering into the leases. Well, clearly that would not be appropriate because it does not meet the similar economic environment criteria. And let's put it this way. You've got a scenario here where the subsidiaries are entering into leases, and if we really are pricing these contracts based on the relevant entity-specific factors and economic environment factors, there's just no way that you could create portfolios that sort of extend across subsidiaries and into other countries without, let's say, some sort of an analysis of group intercompany evaluations and so forth. The foreign currency differences, if those exist, would be enough to probably disqualify portfolio application in this sense. And like I said, I'll let David and Martin talk to that a little bit more later on. And then if you go to example 4, I think basically this one just encapsulates everything I've already said, where an entity or a group, a global conglomerate, is constructing portfolios at a group level where they are determining the IBR at the group level, let's say, because they are determining their entity-specific factors as a group, and then constructing their portfolios in the different countries. In this case, I've actually put 3 to 5 years and 7 to 10 years in my portfolios and different countries. It's obvious here, if it wasn't obvious in example 3, that different geographical locations are going to impact things like the economic environment, and also your foreign currency rates will change that, and those would generally cancel you out on the overall application of portfolio applications. I think the message that we're trying to get across here is you need to construct your portfolios before you construct your discount rates. You need to be clear that your portfolios are similar characteristics and that the application of the portfolio approach doesn't materially change the application if it was applied to the individual lease. And then you need to actually also just look at the 3, shall we call them, higher level factors that influence the incremental cost of borrowing, which are base rates for economic factors, so that's similar economic environment, term and value, the lessee specific financing factors, so your financing factors, and then your asset specific factors such as security. So a very high level, shall we call it, semi-practical application of the standard for the portfolio approach. So then I'm going to bring it together just also, and that's developing an estimate of the IBR. And this is still a semi-practical approach before I hand over to the corporate finance partners. It's really just going to flesh out the concepts that Aletta dealt with right at the beginning, which is essentially the 3 factors that you need to take into account when developing your IBR. So this is coming back to whether you're doing it at an individual lease level, whether you're doing it at a portfolio level where you've actually been able to categorize your portfolios based on similar characteristics and so forth. There really are 3 factors that drive it. So this is the similar economic environment, similar term and value, the lessee specific financing factors, and the similar security and asset factors. So jumping through this, these are broad-based, shall we call them, examples of the sorts of things we would look for. And I'm always has to say that the auditors would perhaps look at these as a sort of a risk assessment. Have you considered, let's say, these 3 factors, and how have you based your practical considerations? So if you move on to the first one, just wait for the slide to change. So the base rate is probably the starting point, and the base rate here is, in the literature at least, refers to a risk-free or low-risk interest rate that would consider similar term, borrowing, and so forth. Now, in the practical sense, very often the base rate is your risk-free rate in your jurisdiction, whether it be a federal bond rate or so forth. So government debt instruments, where you have a 2 or 5 or 10-year bond, whichever the more relevant one to start off with would be. And that generally is the starting rate for a lot of calculations, or at least if you pull it back, it is the general starting point. But what's really interesting here is you must then obviously add your financing factors, your entity-specific factors and asset-specific factors onto that. It's very important you start to run into questions like, well, which is the most appropriate rate to use? Which is the most appropriate government debt instrument to use? So that's the first thing you'd look for if you are constructing your rate. The other thing then is credit risk, and this is then moving on to your financing factors, so your entity-specific factors. And the thing you're looking for here when you're constructing your IBR and adjusting, let's say, your risk-free rate, is to reflect a rate that the lessee would have to pay to borrow. Now, sometimes you can shortcut this, as Aletta said in her second or third slide. Sometimes you don't even go to the base rate and then adjust for credit risk. You might start with a rate of borrowing that the entity or group really has access to, but it is only an input and is only a starting point. That's really important. But if you are starting with a base rate, and as I said, I'll let the corporate finance guys talk to this a little bit more. You do need to look for adjustments that are entity specific, and this is where, let's say, credit spreads may become relevant, which you may take into account. And this is the most common way to, or at least the most common way I've seen, if you're starting with a base rate or a risk-free rate, is to look at credit spreads in the economic environment and for the entity that you may be able to observe for that entity or group. And then moving along, and this is just a quick reflection of security. I think Aletta's got a, oh no, we still won't talk about credit risk here. I actually think that's a repeat slide. Aletta, if we can just move on to the next one, is security. Many base rates, when you finally selected your base rates, and let's say before you've even got to credit spreads, you need to actually understand the construct of those base rates, such as bullet payments at the end. And a lot of the bond rates will actually be constructed on the assumption that there'll be a payment at the end of the term as opposed to every month or every year, which is how leases are constructed. And obviously those are, shall we call them, unsecured. They're not going to be secured over a particular type of asset. And this is something that is often forgotten by a number of entities, because it's probably one of the harder things to conceptualize. How do you adjust for asset-specific rates? And on the security side, it's really just a matter of, does the asset and the security that the asset provides to the lessor actually adjust the rate, let's say due to the ability to repossess that asset or find another tenant in a property lease to take ownership of the asset if there's default by the lessee. And there's two concepts that have generally emerged here, and I'm happy for the corporate finance guys to set me straight on this one, because it is one of the larger ones. But the broad concepts that are being applied on asset-specific adjustments are generally that laptops, computers, and some equipment, there's generally an insignificant adjustment due to the nature of security, although it must be said that those types of assets generally are scoped out of the standard because of their low value by large organizations, whereas for things like property, there is an adjustment that's necessary here based on the asset security and the relative ease of actually finding other tenants and so forth. I think I might have actually fallen out of sync with where the slides are, but the comments are generally included in there. The two slides that are actually just popping up on screen now, the first one, which was the previous one, talks about property, whereas this one that's on screen now talks about laptop, computers, and equipment. The reason why I've kind of steamed through these concepts is they are broad concepts that need to be considered. I actually wanted to give the corporate finance guys some time to talk through these, and so I'm actually going to skip ahead to the next slide, which I think are the practical issues, and hand over to our corporate finance partners to get into some of the detail which you will run into on a practical basis.
Thank you very much, Kevin. For the practical issues, we'll ask David and Martin to get involved here. So I'll just unmute them. So on the very first one, the question that we often get asked, what if an entity has no borrowings? So I often hear that from not-for-profit clients. We have no borrowings, never have, never had, never will. How do we come up with an incremental borrowing rate for the purposes of this lease standard? Martin, can I throw this over to you?
Yeah, thanks, Aletta and Kevin. Excellent overview. I learned a couple of things just by listening to you. As a start, in my view, the IFRS is a principle-based standard, and there will therefore not be 100% correct answers to what the IBR is for a specific lease. It is somewhat subjective, and it is at the end of the day a judgment call, considering the lease standard itself, but also what we would consider in practice. And that's where we come in from a corporate finance perspective. In this specific example on this page, we have no indication of what the incremental borrowing rate is from the entity's own borrowing, and that's probably one of the most challenging of all the examples that an entity might face. So due to that, it has no borrowings. It's, for example, this might be the case for early startups, companies in the biomedical industry, junior explorers, typically companies that can't just go into a bank and get a loan. However, these entities may have leases, such as office space, and therefore, from an accounting perspective, the incremental borrowing rate needs to be estimated. So going back to what I said initially, there's not going to be a 100% correct answer, and the answer may be a rate that is A or B, but what we want to come up with is a rate that is within a reasonable range at the end of the day. So having in mind the factors that's been discussed to come up with incremental borrowing rate, the economic factors, the financing factors, and the asset-specific factors, for a company that doesn't have any incremental borrowing, doesn't have any borrowing at all, it might still have leases. You know, in terms of office, it might have leases for junior explorers, might have mining equipment, very specific equipment, and so on that it leases. The incremental borrowing rate for these may potentially be quite different, and that is because we have to have in mind that the discount rate or incremental borrowing rate should reflect how a contract is priced. So it may be that the terms of a rent of an office lease is not significantly different for a junior explorer to what an IT consulting company would pay or a global manufacturer. Then the incremental borrowing rate would probably be similar to what other companies would pay, and that is only because of security and that an office has a secondary and very liquid market and the ease of finding another tenant and so on. So see, it's all about arguments. If the lessor is requiring a substantial price increases to a certain company versus if another tenant would have entered into the same lease, then the incremental borrowing rate should be higher. Sometimes it's suggested that for a company that does not have any own borrowing or are not able to borrow any money in the credit markets, that the incremental borrowing rate should be closer to the cost of equity. That could very well be the case, especially for leases for very specific assets. Could be very specific. Going back to my previous example, mining equipment again, with a very limited secondary market, and so on. Yeah, so basically, to sum up this page, and what we're trying to say here is that in this scenario, you really have to look at it from a case-to-case basis, and see what might make sense, and what is the specifics of the lease and the entity, the lessee itself, to come up with incremental rate. So Aletta, I guess you can add something here as well, yeah?
Martin, thank you very much for that. I suppose in my experience working with clients, and especially, I do a lot of advisory work for clients, and then they are obviously being audited. And in that conversations between my clients and us and their auditors, incremental borrowing rate is often a topic for conversation. And I have found that it's often in this particular scenario where there are no borrowings, it really depends on facts and circumstances. And I think you've really clearly articulated that this is a principle-based standard. The standard doesn't have all the practical answers. It is subjective, it's a judgment call, but important for clients, and this has been my experience, it's important for clients to consider these things, to get the experts involved, to document their judgments, to document the facts and circumstances, so they've got a defendable position when the auditors arrive. I think it's really problematic to do all this work on leases for 12 months. So on initial application for 12 months, going ahead with a particular discount rate, and at the end of the year, when you have the conversation with the auditor, they might have different views, but also, if you've got a documented defendable position based on facts and circumstances and judgment, I think that's the safest place to be. So I would really recommend that. And I think that's what Martin articulated here as well. When I work with Martin and the corporate finance partners in the space, it's always interesting, the factors in practice and in reality that they take into consideration. This is obviously their field of expertise, and they just have much broader thinking experience to deal with this than I have. So they've been very helpful. Thank you, Martin. So the next one I'll throw over to David. And this is a question we get asked quite a lot as well. And this is if you are doing lease calculations for a group, do you use one incremental borrowing rate for the whole group, or is it different incremental borrowing rates for the group, the parent, and the various subsidiaries, especially if the subsidiaries are in different countries? Some of our clients have subsidiaries in 30, 40 countries, and what's an incremental borrowing rate? How do we do that? So for this one, David, I'll hand over to you.
Thank you, Aletta. Hopefully everybody can hear me clearly. I've got a bit of static in my headphones at the moment, and apologies if it's not great. Now, this is very similar to what Kevin was talking about before in relation to the creating a portfolio of leases that are of a similar nature, and it's a subjective area what is considered a similar lease. But if it's got a similar duration, it's over a similar asset, and it's in the same country, then I think you can probably take a portfolio approach. But you could not have a portfolio where assets are across two different countries, even if they're similar, such as Australia and New Zealand. I would consider them to be two different groups of assets. So first of all, where would I start? I would be looking at which country is the lease in and group like leases in the same country. And start by looking at we talked about risk-free rates before. That's one approach. My preferred approach is actually to use the interbank rate as the base rate. So BBSW in Australia, LIBOR in the UK, and other examples around the world. create the base rate for find the base rate for that subsidiary, find the base rate for that country, and then create a margin. And it's, once again, it might be for an individual lease, or it might be for a portfolio of leases of a similar nature. Creating that margin is very subjective, and I think Martin talked about that before in the previous slide. You need to take into account the assets and liabilities of the group. You also need to take into account the biggest asset that the lessor is going to have access to, which is they can reclaim the space. If we're talking about a property lease, they can reclaim that space and re-let it. The issue being there, though, that there are costs of re-letting the lease or re-letting the space, and there's also some make good provision or make good that needs to be done as well. So there is a cost. It's not frictionless. You need to group leases that have got similar durations and of similar types of assets. So New York in the US would be a different market and different portfolio to, say, something in the Midwest. The only thing that I would say about subsidiaries is that be aware of whether or not there is a guarantee by the parent of the group that is provided to the subsidiary. If the subsidiary has got if there is a guarantee by the parent, then the subsidiary's got access to the assets of the group, and that should be taken into account when considering the incremental borrowing rate and the credit spread that's applied to the base rate. And I think, Aletta, has that covered the issues that you wanted to discuss on that page?
That is perfect, David. Thank you very much. I must say I love listening to you and Martin, and I love all the wisdom that you're sharing with us. It's really nice to learn from you and see a little bit of a part of your world. So thank you for that. So the next one is the question around, bullet loans or amortizing loans. And again, the problem that we can see in practice is leases are similar to amortizing loans because they are monthly payments or 2 weekly payments or quarterly payments, and it reduces over time. However, when you speak to clients, often they have loans with the bank or financial institutions that are bullet loans. So it's being repaid in 3 years' time or 5 years' time. So there's only one repayment date in a few years' time. So if you look at the rate on a bullet loan as opposed to the rate on this amortizing loan, is it really comparable? And that's really the question that I thought I'll throw over to Martin for discussion next. Thanks, Martin.
Thanks, Aletta. Yeah, so on this page, we have this example of a leasee that enters into a 10-year lease with equal monthly payments. Mathematically, the average life of that lease is 5.5 years. So the question is, what is the base rate? What term of the base rate should be based the incremental borrowing rate on? So why is that important in the first place? Yeah, so what's been said previously in the presentation is that the incremental borrowing rate is made up of a couple of factors: economic factors, the financing factors, and the asset factors. In terms of terms of the base rate, in a normal economic environment, the government bond yields over specific with specific terms is usually referred to the yield curve. It's usually upward sloping, so the rate on a 1-year bond is lower than the rate for a 5-year bond, and is lower than the 10-year bond, and so on. That is a little bit different in as we speak right now with the turmoil in the market, but in the normal world, that's the case. So having said that, if you were to base your incremental borrowing rate on a underlying instrument with a term that is much longer than the actual lease term, you would probably apply a too high incremental borrowing rate. So that's the economic factors. And then if we go to the financing factor, the credit risk usually the credit risk that the creditor would assign to a borrower would also usually increase with time. So the credit risk is usually smaller or for a 1 year for debt with a 1 year term versus a 5 year or 10 year. So both the base rate and the credit risk would usually increase over time. And that's one of the important things when we try to match the lease to an underlying instrument. So in this specific example, should this lease, the 10-year lease, the underlying instrument, should we base that on a base rate with a 5-year maturity or a 10-year maturity? And just put things in perspective, the standard itself is not 100% clear on this. It leaves much up for interpretation. I clearly have my own view, which is mine. I actually wrote an article about it that was published by the Chartered Accountants 2 weeks ago. And my view is that the 5-year maturity would better mimic the payment profile of the lease, because as said here on the page, the average life of the lease is 5.5 years. What that means is that the duration of the cash flows of the lease is 5.5 years. And if you then use a 5-year government bond with a single bullet payment at the end, the duration of those cash flows would also be 5 years. So the interest rate risk is matched in that sense. We've seen 10 years as well, and I don't think the standard says that that's completely wrong either. But I'm happy to hear your view there, Aletta, as well, from your experience.
Thank you, Martin. I agree that the standard doesn't necessarily indicate whether in this example we should use the 5-year or the 10-year rates. It doesn't say we have to do a weighted average or not. It really says it depends on facts and circumstances, up for judgment. It doesn't rule out either. It doesn't require either, but leaves it to our judgment. And therefore I'm happy to follow your advice. To me, logically, to use a 10-year bullet loan rate on or did you use a to match the terms specifically, and just focusing on the terms and not taking into account the payment profile just seems a little bit unrealistic and not reflective of the market. Therefore, I would consider the lease term as well as the payment profile personally. So I think we're in a heated agreement there, Martin.
Mm-hmm.
Thank you very much. So for the next one, we are looking at whether we should be using nominal or real discount rates. And here I'll throw over to David.
Okay, so pretty much in the real world we observe nominal rates and hardly see real discount rates. Real discount rates are more in the economics part of the profession more than in finance. But let's go through this case here anyway. So entered into a 10-year contract that's got variable lease payments, and it's on an index rate. Payments are adjusted on an annual basis to reflect the inflation and inflation of the past 12 months. So it's a CPI-based loan. So a lessee may enter into a 10-year lease contract where the lease payments are adjusted annually for inflation and have variable payments. So we've got an indexed rate loan here. I don't see why real rates would be applied. I think the case here is that the principal is adjusted by inflation. I think we are looking at a nominal discount rate to discount this instrument back to present value. I don't see any solid argument to go back to real rates. In fact, in any incremental borrowing rate scenario, and all the ones I've seen from both preparing and also reviewing, nominal rates have been appropriate. It's to use the cash flows that have for the instrument or the lease that have got inflation included in them, and most cash flows that we look at have inherently got inflation in there. You need to go to an effort to get the inflation out and discount it back at a discount rate that has got inflation in it as well. Our base rates, be it BBSW or risk-free rates, have got inflation embedded in those rates. The credit margins also, once you add them on, they're embedded. So it's actually the simplest approach. It's the most consistent approach, and using nominal rates is the only way that I think would be appropriate for this scenario.
Thank you very much, David. Appreciate that. So if you need any assistance, as you would have heard that our corporate finance partners have helped a lot of clients in the space, so please feel free to reach out to them. I just want to flag here that, as Martin said earlier, he's written an article that's recently published on the CAANZ website around determining incremental borrowing rate, and I think that would be a really good article to look at. I've put in the link to the article for you. I've also put in our slide pack, all the free resources that we at BDO have made available to our clients. So as you know, we've got the monthly webinars, we've got interactive e-learning on our website. You can subscribe to our monthly accounting news, which also includes short videos. We've got various IFRS publications. There's a very good one on IFRS 16. And then obviously, if you want to speak to any of our corporate finance partners to help you with incremental borrowing rate or any other matters, I've put their contact details here. So the partner in Melbourne is Stephen, in Sydney, David. We've got Chris, we've got David, and we also have Adam. So a number of corporate finance partners that focus on incremental borrowing rate. I've included their email addresses and their telephone numbers for you. So please reach out to them to help you if required. I've also included our IFRS partners if you're looking for IFRS advice. Not just IFRS 16, but broader. Our email addresses and our contact numbers are there. And this is our big IFRS team, currently very busy with IFRS 16. As I just wanted to remind you also about the appropriateness and the selection of technology solutions. BDO offers BDO lease management services. We also have a software as a service tool where you control the data yourself. We're running IFRS and AASB 16 masterclasses. It's back due to popular demand, running in May and June. If we don't go ahead with face-to-face, depending on the coronavirus situation, it would be virtual sessions. So if you need assistance from us specifically around IFRS 16, on this one slide, a bit of an overview. There's software as a service where you have control. There's outsourcing your lease accounting to us, and we'll take all the hassle away. And then there's also masterclasses if you want to understand it even better and potentially learn how to do your 1 or 2 or 3 leases in Excel, if that's what you want to do. I've included some links for you to our website and videos that we've recorded and demonstration videos of the different services. If you've got questions for the corporate finance partners or Kevin and I, please feel free to reach out via email. Finally, I would like to in particular say thank you very much to David and Martin for joining us. It really is very nice to have our corporate finance partners with us. Usually it's just Kevin and I, and we're not even in the same location. So really nice of you to join us. We appreciate your time and effort. I'll just go back to the slide with the the contact details of our advisory partners. The other thing is the slides are obviously available. It would have been emailed out earlier this morning to all attendees, but this afternoon we'll also send out a link of the recording and the slides. So Kevin, as always, my normal partner, thank you very much for today. Goodbye to Kevin, to David, Martin.
Goodbye,
thank
everybody.
you.
All right.
Thank you very much.
All right, thank you very much, everybody. Have a good week. Stay safe. Bye-bye.